Welcome back, everyone. We're diving deep today into the 2008 financial crisis.
Oh, fascinating and pretty complex topic.
It is. And to guide us, we have Gillian Tett's book, Fool's Gold. It gives a great insider's perspective on, well, what led to this massive economic earthquake.
Right, from those involved.
So picture this. Bankers on a beach in Florida brainstorming financial instruments. Sounds relaxing, right?
Not exactly the image that comes to mind when you think about a global financial meltdown, huh?
Nope. But that's where the story starts, believe it or not. Early 1990s, J.P. Morgan. They're developing these things called credit derivatives.
And it's interesting, really, because J.P. Morgan, they were both the innovators and, well, trying to figure out how to manage the risks.
So kind of like writing the rule book while playing the game.
Exactly. But even then, early on, regulators were like, hold on a second, this might be a problem. E. Gerald Corrigan at the New York Fed, he saw the potential for trouble.
What were they worried about specifically?
Systemic risk. The idea that if one of these new instruments goes bad, the whole system could come crashing down.
Like a domino effect?
Precisely. And J.P. Morgan was actually involved in these early discussions about how to regulate these things.
So they were aware of the risks.
Oh, yeah, to a degree. But there's this guy, Mark Brickell, a banker at J.P. Morgan, and he fiercely opposed any government intervention.
Really? So even within J.P. Morgan, there was disagreement on how to handle this. Did anyone listen to Corrigan's warnings, though?
Well, a report by the Group of 30, which included, bigwigs like J.P. Morgan's CEO, they did say risk management is important.
Okay, so at least that.
But they ultimately decided that the industry could self-regulate.
Looking back, that sounds like a pretty big missed opportunity, maybe, to put some safeguards in place.
It's certainly something to think about. That lack of early regulation, it allowed the derivatives market to grow rapidly and become really complex.
And less transparent, I imagine.
Oh, absolutely.
And this is where Blythe Masters comes in, right? With credit default swaps and the bistro model.
Yeah, the broad index secured trust offering.
I gotta say, that sounds more like a fancy coffee drink than a financial instrument.
It does, doesn't it? But it was a way for banks to reduce the risk they held from loans.
Okay, so how did this bistro thing actually work?
Well, imagine, a bunch of different loans all bundled together, and then they'd slice this bundle into different pieces, kind of like a cake.
Okay, I'm following so far.
And some slices were considered safer than others, and investors could choose which slice of risk they wanted to buy.
So spreading the risk around, essentially.
Exactly. And they use these things called special purpose vehicles, or SPVs, to hold these bundles.
Okay, why was that important?
It allowed banks to move the risk off their balance sheets. Think of it like putting your valuables in a safe deposit box.
Out of sight, out of mind.
Kind of, yeah. But here's the catch. These SPVs were often insured by companies like AIG against super senior risk.
Super senior risk.
Yeah, the risk that even the safest slice of these bundles would default, super unlikely. But if it happened, huge consequences.
Because AIG would be on the hook for massive losses.
Exactly.
So it seemed like a clever way to manage risk, but actually created this hidden concentration of risk.
You got it. And as the bistro model gained popularity, well, other banks wanted in on the action.
And not just for, regular corporate loans.
Right. They started using it for mortgages, even subprime mortgages.
Which were riskier, weren't they?
Oh, definitely. Loans to borrowers with lower credit scores, higher chance of defaulting.
Yeah.
But the bistro model made them seem less risky.
So the model designed to manage risk is now being used to package and maybe even hide riskier assets. That can't be good.
Yeah, the recipe for trouble was brewing.
Were there, any individuals within the industry who saw this coming?
Well, there was this guy, Bill Demchak. He later became a big shot at J.P. Morgan Chase. But before that, he saw firsthand how Chase was making loans to companies involved in risky stuff. Companies like Enron, the one with all the accounting scandals.
Right. So even before the housing bubble really took off, there were red flags.
Definitely. And things only got more complicated from there.
So we've got this system that's relying more and more on these complex instruments, warning signs that are being ignored, and everyone just seems to want more risk. Was there anything that sped this up even more?
Yeah, the repeal of the Glass-Steagall Act in 1999. Big change.
I vaguely remember hearing about that. What did that do?
Well, before, commercial banks and investment banks, they were separate. Couldn't take on too much risk.
Makes sense. So what happened?
After the repeal, Mergers, acquisitions, the whole industry started, well, reshaping.
And I bet that created pressure to make more profits, right? And that means.
More risk, exactly.
Wow.
And this hits JP Morgan, too. They merged with Chase Manhattan. Massive new institution. But here's the thing. Two very different cultures.
Ooh.
Yeah, JP Morgan, more conservative, careful.
Yeah.
Chase Manhattan, more aggressive, all about the profits.
Ooh, that sounds like a recipe for some internal clashes.
You could say that. Bill Demchak, the guy we talked about before, he saw it all firsthand.
Yeah.
He noticed Chase Manhattan had been doing some, well, let's just say questionable lending even before the merger.
Like with Enron.
Enron, exactly. They were one of their clients.
So Chase already had this appetite for risk. Makes you wonder how much JP Morgan really looked into that before saying yes to the merger.
Yeah. Interesting point. Sometimes growth and profits can overshadow, careful risk assessment.
For sure. So what about the bistro model? Did the merger affect how that was used?
It did, unfortunately. JP Morgan Chase, the merged bank, they kept using it, even expanded it.
Oh, no.
And they weren't the only ones. Other banks, they saw JP Morgan doing it seemingly successfully and jumped on board. And they started using it for, well, riskier and riskier assets.
Especially those subprime mortgages we talked about.
Yeah.
So the model that was supposed to manage risk, now it's being used to package and sell off the riskiest stuff. It's like the idea that risk was reduced, it almost created a false sense of security.
That's a really good way to put it. It's like when something seems safe, people take more risks, and that can backfire spectacularly.
And that brings us to Jamie Dimon, right? He becomes CEO of JP Morgan Chase in 2004. So we've got this risky environment, and Dimon comes in. What was his approach to all of this, to risk?
Dimon, he was all about risk management, very cautious, detail-oriented guy.
That sounds like a good quality for a CEO, especially given, everything that was going on. So how did he react to what he was seeing at JP Morgan Chase?
Well, at first, he was interested in mortgage securitization, saw the potential,
Right.
but pretty quickly he realized something's not right here. He and his team, they started noticing borrowers defaulting on these subprime mortgages, like at an alarming rate.
That's not good, even though the economy was still doing all right at that point.
Right. Economy's good, interest rates are low, but people are still defaulting.
That's a big red flag. What about other banks? How are they reacting to this?
A lot of them, they either ignored it or just downplayed it. They were still focused on the housing boom making money.
So Dimon was seeing something that others were missing, or maybe just choosing to ignore. What did he actually do at JP Morgan Chase?
He started reducing their exposure to mortgages, specifically subprime, pulling back, even though it could have meant losing profits in the short term.
That's a bold move, especially when everyone else was piling in. Why do you think he was so skeptical?
I think it comes down to his understanding of risk management. He'd seen cycles before, knew things couldn't go up forever, and he was also really wary of how complex these mortgage-backed securities were becoming.
He also had, access to a lot of data and analysis at JP Morgan Chase. Did any of that support his gut feeling?
Oh, absolutely. They were crunching the numbers on mortgage defaults and seeing a clear pattern. This wasn't just a few isolated cases. It was systemic, potentially a huge problem.
So while others were focused on the potential profits, Dimon was looking at the data, and he was seeing the cracks in the foundation. But even with his cautious approach, could JP Morgan Chase completely avoid what was coming?
It's the tricky thing with systemic risk. It's contagious. Even if you're careful, if enough people around you get sick, you can still get infected. In the financial system, it was so interconnected, it was almost impossible to stay completely isolated.
So even as Dimon's trying to steer JP Morgan away from the iceberg, everyone else is heading straight for it. Were there any warnings from outside the industry about the risks?
There were, actually, but they were largely ignored.
Really?
Yeah. The Bank for International Settlements is a global organization of central banks. They had raised concerns about derivatives back in 2003. They were worried about the potential for instability.
Wow, that's pretty amazing foresight. But it seemed like no one was paying attention. Why do you think that was?
A few reasons, I think. First, the industry was making a lot of money from these derivatives, so there was this incentive to downplay the risks. Second, these things were complex, hard to understand, even for regulators. And third, there was this belief that the markets would self-correct, that the government didn't need to intervene.
A combination of greed, complexity, and maybe a bit of blind faith in the markets. But Even with all these warning signs, things seemed okay for a while, on the surface at least. Was there a specific event that signaled the beginning of the end?
Yeah, the Bear Stearns hedge fund crisis in 2007.
Yeah.
Two of their hedge funds, they had invested heavily in mortgage-backed securities, and they collapsed, sent shockwaves through the whole system.
That sounds like a pretty big wake-up call. Did it change anything?
Unfortunately, not really. A lot of people still thought the housing market would recover, that this was just, an isolated incident. But in reality, it was just the tip of the iceberg.
So even as Diamond's trying to navigate JP Morgan Chase through these dangerous waters, the storms brewing, what happened next?
That's when things really start to unravel. The Bear Stearns crisis, it was just a taste of what was to come.
So things are starting to unravel. The Bear Stearns crisis, just the tip of the iceberg. Where do we go from there?
July 2008, another big player runs into trouble.
Mm.
Deutsche Industry Bank, DIB, a German bank.
DIB. So this is spreading beyond the U.S. now.
Yep, spreading globally.
Hmm.
DIB, they were also heavily invested in those mortgage-backed securities, just like a lot of American banks. Yeah. And when the housing market tanked, well, they had a liquidity crisis.
Hey, a liquidity crisis. What does that actually mean?
Basically, they didn't have enough cash on hand to cover their immediate debts.
Yeah.
Like, imagine having a ton of valuable stuff, but no cash to buy groceries.
Ah, I see.
That'd be they couldn't find buyers for their commercial paper. It's a short-term debt thing companies use to raise money quickly.
So they were running out of cash. What did they do?
They went to JP Morgan Chase for help.
Interesting. Given Diamond's cautious approach, trying to steer clear of those risky assets, I wonder how he reacted to that.
He didn't bail them out?
He didn't.
Nope. Diamond, he saw that DIB was in too deep, and a bailout would be too risky for JP Morgan.
Wow. Must have been a tough call. So what happened to DIB?
The German government had to step in. They bailed them out to prevent a collapse.
So the problems in the U.S. housing market end up triggering a bailout in Germany. It really shows you how interconnected the global financial system had become. Did this DIB situation, did it change how people viewed things?
It definitely made people more nervous, yeah. But there was still this hope that, the worst was over. But as 2008 went on, the markets, they really started to panic. Banks wouldn't lend to each other, worried about counterparty risk.
Worried that the other bank might go bust.
Exactly. And then investors panicked too, leading to a massive sell-off in the stock market. And this is when the shadow banking system really came into focus.
Right, the shadow banking system, those SPVs, the special purpose vehicles, they were a big part of that, right?
The shadow banking system is basically all these financial institutions operating outside of the normal banking regulations. And they were heavily involved in all that mortgage securitization,
Yeah.
Through those SPVs.
So taking on a lot of risk without the same safeguards as regular banks.
Exactly. And because they were operating in the shadows, it was hard to see how much risk they were actually carrying. And when the housing bubble burst, the whole shadow banking system, it basically imploded.
Like a house of cards.
Pretty much.
Yeah.
And this led to some major financial institutions going under. Lehman Brothers, a huge investment bank,
Yeah.
they collapsed in September 2008.
I remember that. It felt like the whole world was about to fall apart.
It was a pivotal moment, for sure.
So what happened then?
The government had to step in, big time. Massive bailouts to prevent a complete system collapse.
Yeah.
AIG, they were about to go under because of all those credit default swaps.
Right.
So the government bailed them out, and they provided support to other major banks, too.
But they let Lehman Brothers fail. Why was that?
That's a question that's still being debated. Some say it was to show that, there would be consequences for reckless behavior. Others think it was a mistake, that it actually made things worse. It definitely had a huge impact on market confidence.
It must have been incredibly intense, making those kinds of decisions with so much at stake. What about Jamie Dimon? What was his role in all of this?
Diamond. Well, he had been trying to guide JP Morgan Chase through this mess, and he ended up playing a key role in trying to stabilize things. He helped arrange the sale of Bear Stearns to JP Morgan and worked closely with the government to try and find solutions.
So the guy who's sounding the alarm, he ends up being one of the main players in dealing with the fallout.
Yeah, that's right.
It's been quite a journey. We started with those bankers on a beach in Florida, and we ended up with a global financial crisis and government bailouts. What are some key things we can learn from all of this?
Well, I think it shows how dangerous unchecked greed can be.
Yeah.
And how financial innovation, while it can be good, it can also have unintended consequences. Strong regulation is crucial, and we need more transparency, more accountability in the financial system.
And maybe a little less complexity when it comes to financial instrument.
For sure. And it's easy to forget, but this crisis had a real human cost. People lost their homes, their jobs, their savings, all because of the decisions of a few.
A good reminder that the financial world, it's not just numbers and markets, it's people's lives. This has been a fascinating deep dive. Thanks for sharing your insights.
My pleasure.
To everyone listening, if you want to learn more about this, this pivotal moment, we highly recommend Gillian Tett's book, Fool's Gold. It's a great read.
And remember, stay curious, stay informed.
Thanks for joining us.